the Fed published M2 data a few days ago for February, and I calculated from January it went up 10.5% on an annualized basis. So that's how I view inflation. Yes, the Iran war is going to cause higher prices at the pump, higher prices for everything because energy and transportation and everything else is related to oil. But yeah, even if we hadn't seen the spike in oil, I think the what people call inflation, CPI, was going to go up anyway.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today we have a fantastic discussion to work through with Mario Innecco, host of Mnt&x YouTube podcast, which is known as the home of alternative economics and contrarian views. Mario, it's an honor to have you on Metals and Miners for the first time. Welcome to the show.
Thank you for having me, Gary. It's an honor to be here too.
All right, Mario, you've been in the financial markets and macroeconomics as an analyst and in various roles, actually, for decades. You've made a career in options, futures, banking, derivatives, and other market areas for large firms. Aside from your own analysis, you now also interview many market and economics experts yourself, and you gain from their knowledge and their insights. There's so much to discuss today, but before we do, what is the big takeaway for those tuning in right now that you hope that they're going to walk away with after listening to our conversation?
The takeaway is that we have a debt problem, not just the United States, but the whole world, and that the central bankers and politicians are going to keep inflating. And by inflating, I mean they're going to keep borrowing and spending and running deficits because that's the only way out. Because under our current monetary system, there's never enough money to pay the debt. So it has to keep going.
So, I was going to start with the Iran war, but before we do, based on what you just said, I just have a quick question for you. So the U.S. has something like 125% debt to GDP. If they print and inflate like that, they're going to cause a massive inflationary wave. Is that your expectation over let's just let the markets and economy fall to whatever equilibrium point that it could find, which many people believe that would be essentially it would fall to a Great Depression level. Despite the 125% debt to GDP, do you think they would still go ahead and print?
Yeah, because the Federal Reserve, its two main objectives are full employment and stable prices, but it also has a third one, which is financial stability. And I think if it sticks to stable prices, i.e. keeping CPI or PCE at a certain level, it's going to put the financial stability and full employment into jeopardy. So I think they'd rather save the economy and the financial system at the expense of higher inflation.
So essentially, they would sacrifice the dollar in order to do that.
Yeah, they've been doing it already. The fact that gold went up to 5,600 recently, that in the old days, before you and I were born, would have been seen as a devaluation that, the currency buys less gold.
Yeah, true. All right. So, we've got the Iran war raging right now. Actually, it's kind of on a little bit of a pause, but I guess that's from the threat of extreme actions. But the Iran war is going on. We've got economic impacts coming down the pike. What's your read on likely inflation in terms of 2026 that we should be expecting?
Yeah, this morning I made a video about M2 actually, and the Fed published M2 data a few days ago for February, and I calculated from January it went up 10.5% on an annualized basis. So that's how I view inflation. Yes, the Iran war is going to cause higher prices at the pump, uh, higher prices for everything because energy and transportation and everything else is related to oil. But yeah, even if we hadn't seen the spike in oil, I think the what people call inflation (CPI) was going to go up anyway, and the economy already is slowing down. We saw the fourth quarter GDP at 0.7, even so that's even before the war. So uh, at best is going to be a stagflation. At worst is going to be kind of a recessionary stagflation, I would say.
So the M2 is really a Milton Friedman take, right? And so what we're looking at here, you said 10. How much of an increase?
10.5% annualized.
10.5%
From
annualized
January to February.
January to February. So you're expecting, based on that move, a large spike. I mean, give us a gauge for what you're expecting in 26. Is it 10.5%?
For the CPI, they always can keep that down, but I could see it going to 4, 5, or 6. The CPI, and maybe even more. But they always find a way to tweak the CPI, not just in the U.S. but here in the U.K. as well. They did that in 2022. They tweaked it, and yeah, I mean, I'm not a fan of Milton Friedman on everything because he thought gold was going to zero when Nixon closed the gold window. He's not really into sound money, but yeah, one of the things that I agree with him is that if the government and the central bank create a lot of currency and credit through the banking system, and the economy doesn't grow as fast, well, that's too much money chasing too few goods. I mean, you don't have to have a PhD to understand that. But as you said, no one really watches M2 anymore. They all watch CPI, PCE, inflation expectations, break-even levels for tips, uh, which we know a lot of it is manipulated, these bond markets. So you can manipulate the inflation expectations.
So you mentioned how the war in Iran is very costly in many ways. You know, the cost of everything affected by oil, but also plastics, fertilizers, helium. They're all rising because a percentage of their production has been taken offline, basically as casualties of this war. With all these costs rising, the second order of effects likely to strike businesses and consumers everywhere. What are you anticipating in terms of action by the Federal Reserve, led by the new chair, Kevin Warsh, assuming that he gets installed?
Yeah, I would add to the costs as well the fiscal costs for the United States because it costs a lot of money to wage war anyway. But as far as Kevin Warsh is concerned, I think he will get um, like voted in by the Senate. I think they approve him, and he. There was a lot of speculation when he was announced, and gold, I think, took a big hit that he was going to shrink the balance sheet. He was against QE, but I actually think it's more nuanced than that. He basically wants to shift the yeah the he wants to outsource the QE to the commercial banks. So I don't think he's going to change anything. If anything, he might add uh, the 3 trillion, let's say, of treasuries that the Fed holds. That could be shifted to the that amount could be shifted to the banking sector, and the banking sector could actually use this power to borrow another 3 trillion to lend it into the economy. So I think it would be even more inflationary. And I think along with Secretary of the Treasury Besant, they're looking to keep the issuance of that in the short term, like T-bills, just like Janet Yellen was doing. And the Fed is, since December, they've done over 120 billion in QE to buy short-term paper. So yeah, I think they're between a rock and a hard place. They're trying to come across as hawkish, but they're actually not. So I don't think anything will change with Warsh. If anything, he might even be de facto even more dovish than Jay Powell.
Yeah, and the yields have been rising pretty steadily since the war, and by many analysts' calculations, there's something like 10 trillion in maturing debt that has to be rolled over here over the coming months. With the higher yields, is the Fed going to be able to do anything in order to improve the interest cost, so to speak, because the debt servicing payment is now over $1 trillion. It's been calculated as being more expensive than defense spending. And now with the higher yields impacting this potential maturing debt, that could go up quite a bit from here.
Yeah, and I think that's why they're going to try to stick to issuing short-term debt. But even short-term debt has gone up a little bit, the yields. Right. So they have a problem. I think they might accelerate the amount of QE because Powell announced about 40 billion a month. They could raise that to like 60 or whatever level they want. And the other thing they could try to implement, which is kind of QE light, is yield curve control. So they might be doing that already because we see like today we got very close to 5% on the 30-year yield, but it's now dropped back, and we got very close to 4.5 on the 10-year, and it's dropped back. So I'm sure they're trying hard to keep that that kind of level. The yields from not going above those levels. And it's very important for them because it also not only impacts the cost of financing the debt for Uncle Sam. I think right now it's the debt interest cost is about 1.1 trillion, and it's getting very close to 20% of tax receipts, which isn't good. And so and it also translate into higher mortgage rates, which doesn't help the economy either.
Yeah, a lot of ramifications. All right, so everyone out there is wondering, why is the price of gold plunged about 20% from its record high around the start of the war? Gold as a safe haven should have gone up on the worsening inflation outlook. It should have gone up on the mounting geopolitical risks. These are all usually very bullish developments for gold and should remain so. What's your read on why gold has fallen like it has?
Yeah, I mean, the first day of trading after the war started, gold and silver did go up, and then it's been going down. And yes, treasuries have been going down too, so they haven't acted as a safe haven. But the question is on gold. I agree. I had a look at what gold and silver did in 1973, because back then in October, the oil producing countries, OPEC, and under the leadership of the Saudis, they imposed the oil embargo, and oil went through the roof. It used to trade around $3, and it went up to 12 in the next 6 months. And it took gold and silver dropped for the first few weeks or first month of that crisis, and eventually it took off. So I'm not saying it's exactly the same thing that happened in 1973, 74, but it's similar. And we forget as well that during times of crises like we're having now, gold has actually, I would argue, acted. It's done what it says on the tin. It provided liquidity. Case in point, Turkey. They've had to swap or sell their gold and then have a contract to buy it back in the future because they needed the funds. And it's very easy. It's the most liquid asset, and it has been for thousands of years. So I would argue is some of that. And I would argue as well that there's a lot of uncertainty. We don't know in the next hour what's going to happen. We keep getting conflicting comments from the Trump administration, from Iran, from everyone. So as we speak today, though, I noticed that gold and silver are doing very well, while the stock market is down about 1%. So is this the end of the period of seemingly gold having lost its safe haven status? It could be. And I'm still of the belief that it will act as a safe haven. I just think there's still a lot of uncertainty relative to what energy prices are going to do. I mean, we're still told that if the war ends, oil price will go right back down and everything will be okay. But I think there's a lot more to it because a lot of the production capacity in the Middle East, there's a lot of like backlogs as well worldwide for everything. And I think, if the war were to end tomorrow, I think it could still impact the economy for at least another year. And I don't think the war is going to end tomorrow. I think it could drag on for a long time.
Yeah, and you're right. There's a clear decoupling today between the stock market and the precious metals, and it is intriguing why it's happening. You're right that it acts as a source of liquidity in times of crisis, and there's reports that the Gulf Coast countries that have taken a lot of hits needed to raise cash fairly quickly. So yeah, it's and I think you're right about that it's following a similar trend line to the past, and so none of these things are necessarily out of the ordinary. And for those who were patient in previous times of crisis with gold, they saw it go much higher than even before the crisis began.
Yeah, and I would add, Gary, that oil as well. This war started. When was it? 28th of
February.
February, and oil only broke through. Let's see, I'm looking at the chart here. Only broke through 100 on the 8th of March. So it took over a week. So what I'm trying to say here is markets are, they're never, it's like the seasons. Spring is supposed to start on the 21st of March, but here in England, it still feels like winter. So, things are not always perfect. There's a bit of leeway.
Yeah. Volatility, ebb and flow. Yeah. All right. So in times of war and crisis, investors have historically flocked to treasuries. Many guests have come on here recently to Metals and Miners, and they've stated that they believe that the U.S. is headed for a sovereign debt crisis. With gold dropping and treasury yields rising, what's your case for gold being better than sovereign credit, and why investors shouldn't allow the beating war drums and the falling gold prices to lead them to panic sell their gold?
Well, the main reason why I think gold is better than sovereign debt is because the gold is neutral and there's no counterparty risk. you hold a gold coin or a gold bar, that's no one owes you anything. You've got the money. You have a treasury note or a treasury bond or bill. If you want cash, you need to go and sell it. And maybe the broker that holds your treasury might not, like MF Global years ago, they went bust, and it took months for you to get your securities back. Or I'm not saying the United States is going to default, because they can always print. So, and I think that's what's going to happen. You know, I don't, Alan Greenspan said some years ago that we can always print, he said. And Austin Goolsbee was next to him, and he went like this.
He said, the U.S. will never default. We could always print.
Yeah. So that's the default. And that's why, and gold doesn't default. Gold just sits there, and you can't conjure it up out of thin air. You gotta mine it. It's not easy mining. First, you have to do some exploration, and then there's all kinds of risks as well involved.
So, if the economies of the world move towards this type of crisis as a result of this war and the overarching debt and the macro setup that pre-existed the war, presumably gold would skyrocket as capital flows leave the stock and bond markets, and they also leave cash, and they flee to sound money, right? Is that your base case, that you're expecting that capital is going to flee the stock and bond markets and cash and rush towards sound money, gold?
Well, I think cash is still not a bad thing to have, because we still can't pay for things with gold, unfortunately. Turkey just proved that. But I think in terms of asset allocation, yes, we're not going to, I don't think we'll see a massive rush. But the point is that so little is invested in gold. I think it's about 1% at the most of all investable assets are in gold. And we still have this 60-40 portfolio of stocks and bonds. So even if you were to get 5% of all the capital that is parked in treasuries and other government bonds flowing over to gold, that would be massive. That's like 5 times more than there is in gold. And then if you add the general stock market as well, let's say another 10%, the sky is kind of the limit. But I'm not saying people are going to rush, completely all into gold. I don't, that would only happen maybe if people lost complete faith and confidence in the monetary and governmental authorities. That would be more like Weimar Germany, which is possible, but
maybe not probable.
Not probable, yeah. But
in your base case, how is the stock market behaving?
I think the stock market is going to stay pretty strong in nominal terms, because the powers that be are going to keep the liquidity going, because the top 10% wealth percentile in the US, I think they consume more than 50%, makes up more than 50% of consumer consumption in the US, which is really important for GDP. So they want to keep the stock market souped up. But yeah, in nominal terms, it will stay high. But I think you need to measure it versus gold. Mm-hmm. And we are seeing that we're around 10. The Dow gold ratio 2-3 years ago was just above 20. So I foresee that ratio going a lot lower, to at least 1-to-1.
Yeah. So in that scenario where equities are still, we'll call it relatively attractive to the masses of the people, maybe because they don't understand what you just described there, gold versus stocks, the 1-to-1 ratio that we saw years ago, and that could be coming back. The gold mining stocks, their free cash flow should explode in this base case scenario as capital flows increase towards gold, and inflation is increasing, et cetera. Do you believe investors are going to view this as begin to see them as safer investments, even over traditional equities, maybe even over bonds, and begin migrating over to these gold miners that are, showing escalating, increasing, expanding free cash flow margins?
Yeah, and silver as well, I would say. And even before this very painful correction we've seen in the miners of late, they were already undervalued, so they're even more undervalued now. As for whether investors are going to rush into it and see it as a safe haven, it's possible. I definitely see it as a good place to be. But I would add that you need to manage your risk there, because it's very volatile. It's not for the faint-hearted.
It's definitely not. All right. So since the start of the war, silver has been much harder hit than gold, as it's viewed not only as a monetary metal, but an industrial metal. Are you seeing changes around the globe in how investors view silver, and what role are you expecting for silver to play moving forward for the investing class?
Yeah, we're definitely seeing silver change from not just like industrial metal, even though that's still very important, but we're seeing countries now also starting to buy silver as a yes, as an alternative to treasuries, as like a safe haven. India is very much into that, and so is China. I think in India they're going to allow people to use silver as collateral for loans. Prior to the war, I was hearing that the Gulf cooperation countries, they were not just buying gold, but buying a lot of silver as well. And also, the supply situation has been precarious for silver for the last 6 years or so. And we're seeing, Gary, as well, I'm sure you're looking at this, that the registered inventories on COMEX are coming down quite sharply, and that there's almost no silver left in Shanghai. So silver, I think it was Jim Sinclair who said that it's like gold on steroids. So it will go up very sharply, but it will also come down very sharply, and that's what we've seen this year. But I expect silver to outperform gold going forward, because that's what it has done in the last 60 years or so when we've had bull markets in the precious metals.
Are you in the same camp, Mario, as Michael Oliver, founder of Momentum Structural Analysts, in that the drop silver has experienced, the volatility silver has experienced, is currently, it's similar to what was experienced in the 79-80 run-up and the 2011 run-up. At one point, he was calling it a little wiggle in the charts, but I mean, it doesn't feel like a wiggle when you're going through it. But it then took off like a rocket ship to a new pricing paradigm. Or do you have a different expectation for silver moving forward?
I agree with Michael Oliver. So yeah, and I think when you look back, the correction we saw at the end of January, beginning of February, is going to look like a blip, just like the stock market in 1987 dropped 22% in a day. If you look at the long-term charts now, you can't even see it. And I think by the end of the year, the Dow was making another all-time high.
Yeah, it's interesting you bring up the 1987 crash. My grandparents, who have long since passed, they were over our house, and my grandmother told me the day after that, she said, we just lost $25,000 in one day on paper, But interesting. Yeah. All right. So, Mario, I'm sure you've seen this. There are $100 Treasury note bills that are coming, and they're going to have President Trump's likeness and his signature on them. So, a new $100 bill. Some analysts are suggesting that the release of these notes will have the backing of gold and silver, and it'll be timed with the USA's upcoming 250-year anniversary on July 4th. Other analysts are suggesting that there is a different scenario unfolding, that there's such a sizable faction of citizens who won't touch the new cash with a 10-foot pole if President Trump is on it, because of their hatred for him. And therefore, it's going to quicken the pace of the move to a digital currency. And that's actually part of the purpose behind the deployment of the notes. What is your read on these new Treasury notes that have been announced?
Are they just Treasury notes, or are they going to be also Federal Reserve notes? I don't know.
Yeah, I mean, I think they're going to be
Yeah.
cash. Yeah.
Yeah, but I heard they're thinking of a $250 bill because of the 4th of July, the 250th anniversary. But
Interesting.
that's possible. That I didn't know his likeness was going to be on the note. I thought he was just signing it. But
Well,
if
maybe
it
you're
is,
right. That's what I saw.
I can, yeah, I can tell you that I was in the U.S. In January of 2015, just before the inauguration. I went to visit Andy Schechtman of Miles Franklin, and we went to play golf at President Trump's golf club in West Palm Beach. And after I finished, I went to the pro shop to buy some merchandise, and I was going to pay cash, and they said, "No, sorry, we don't take cash." So who knows? But I don't think the notes are going to be backed by gold or silver, um, only because the Constitution really doesn't say anything about treasury notes or bank notes. It says that Congress has the power to mint money, which is gold and silver, and the greenback only came about in 1862 during the Civil War, where they had to help finance the Civil War. So they came out with the legal tender laws. And ever since then, government has been able to borrow and print a lot more, even under a gold standard. So my as a sound money proponent, I don't think just because President Trump is signing a Treasury or a Federal Reserve note means anything at all. I think what needs to be done is the abolition of all these legal tender laws and the abolition of the Federal Reserve. That's the only way back to constitutional money. Anything else is a gimmick.
Okay, so with all the many incredible experts you've had on your podcast, what is a central theme that you keep hearing over and over and over from them that you can share with our listeners?
Well, the central theme is the debt, and in a fiat currency system, that you just have to keep going, or else the whole system implodes. And that's what I told you in the beginning as well. From the people that I've had on my channel, that's what they all say.
And that's why it's essentially a mathematical certainty that they're going to be printing.
Yeah, that's right. And we know historically that fiat currencies always go to zero. And I mean, you could argue the dollar has been around for a long time, but you could also say that the dollar today is not the same as the dollar prior to 1933 or 1862, right?
Absolutely. For those who are tuning in, you're referring to FDR's executive order in 1933, correct?
Yeah, that's right. And it basically made gold illegal as a monetary instrument. So it killed the well, it was against the Constitution of the United States. So it killed the gold standard, and also it neutered the Constitution, which said that only gold and silver should be money. It took the gold out of it. Silver is still around.
Yeah, I mean, you used to be able to back then, prior to that executive order, you could take, your $10 note or $20, $50 note, $100 note. You can walk into any bank and walk out with real money, your gold. After that didn't happen. And then the populace was led to believe that the dollars that they held was the money in lieu of the gold. And they learned to believe something that just wasn't true.
Yeah, and it's been so long that people don't remember it. People don't know. They have been taught in school or higher education. And you could also take jewelry to the mint, and they could turn it into coins. They would charge you seigniorage, which is like 1% of the gold.
Well, and what we're talking about here is why inflation is so damaging and confusing to people. They don't understand why, on the whole, why they are being so dramatically and negatively impacted by inflation. And if they could be holding their gold instead of those paper dollars, they wouldn't be feeling the effects of the inflation. So, Mario, what haven't we discussed today that we should be considering for 2026 that you think 2026 is going to bring, and it's really important for us to be considering that?
I don't think we've missed anything. I mean, we've covered the bond market, we've covered the war. So I think those two are really the most important ones. And maybe, I guess, politically, I don't get too much involved in politics, but the midterm elections could be quite significant for the US and the whole world, for that matter.
Yeah. I think as soon as we start making our way through summertime, it's going to ramp up over here, and we're going to start feeling the effects, and then the results of that will start feeling the effects. Well, this has been an incredible discussion with Mario Innecco. Before we wrap up, I want to direct everyone interested in the metals and mining sector to go visit our Substack at manipulated.Substack.com. When you join the quickly growing community, you're going to receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report you'll receive. Now, I'm positive you've been enjoying the conversation Mario and I have been having. Would you please let him know by hitting the like and subscribe button and leave a comment below the video? All right, Mario, as we wrap up our discussion for today, would you please share a key takeaway to leave with the viewers, and then let everyone know where they can learn about your work and how they can connect with you?
Yeah, my key takeaway is to live within your means in order to have some excess fiat currency, so you can convert that into real money, i.e. gold and silver, and do it on a dollar cost averaging basis. And yeah, you can find me on YouTube, Mnt&x64, and also on X at Mnt&x64.
Wonderful. I'm going to have that information up on the screen. And guys who are tuning in, there'll be links in the description area for you to click through and get over to Mario and follow his work. Mario, thanks for coming on to Metals and Miners. You've been a lot of fun to spend time with. You've been generous with your time and analysis and ideas, and we really appreciate it. Look forward to having you back on sometime soon. Everybody who's tuning in, thanks for watching. Direct everyone interested in the metals and mining sector to go visit our Substack at metalsandminers.substack.com. When you join the quickly growing community, you're going to receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report you'll receive.